In today's episode, we'll break down two important stories. First, we'll talk about Q4 at India's biggest jewelers, and then we'll talk about SEBI wanting to make municipal bonds great. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara, and today is Tuesday, 19th May. Coming to the first story. So on paper, the March quarter was a roaring one for Indian jewelry. Titan, the largest of the country's listed players, saw its consolidated income grow by 80% over the same quarter a year earlier. Kalyan grew at 66% and PN Gadgil more than doubled its revenue. If you thought high gold prices would make jewelry harder to sell, surprise, all three of these companies' sales figures were better than ever. Or maybe not. Peek underneath the revenue figure and you see the three companies pull away from each other. Titan saw its gross margin absolutely crater by 600 basis points, and the gross margins of PN Gadgil too took a beating of 230 basis points. Kalyan, on the other hand, managed to defend its numbers. Now, the three companies may have shared the same business conditions, but their businesses told three completely different stories. Now, that divergence is interesting. It shows us how different these companies actually are in a way that a calmer quarter would have hidden. And those differences will only matter more going ahead now that the government has more than doubled import duties on both gold and silver. Going by absolute scale alone, Titan had a wild quarter. Its consolidated total income was around Rs 27,100 crore, up 80% year on year. Some of that came from bullion and digital gold. But even if you strip that out though, its underlying income came to Rs 20,300 crore, still up 46%. Its net profit at almost Rs 1,180 crore was up 35%. But this wasn't a normal quarter by any means. For one, Titan's bullion business has become enormous. So consider this. Standalone bullion sales went from Rs 860 crore in Q4 last year to Rs 6,140 crore this quarter, a growth of over 7 times in a single year. In fact, bullion made over a quarter of Titan's standalone jewelry revenue this year, and that shift came with a terrible price. Bullion carries almost no margin, and as Titan ramped up bullion sales, its gross margins collapsed by a full 600 basis points from a year earlier. But that said, its jewelry business held its own, with operating profits reaching Rs 1,820 crore, approximately 37% better than last year. But the sort of jewelry it sold shifted slightly, with its share of studded jewelry slipping from 34% to 31%. PN Gadgil grew even faster. Its consolidated revenue for the quarter at over Rs 3,500 crore was up 123% for the year. Meanwhile, its net profit came to Rs 90 crore, up 46% year on year. And yet, the markets didn't take to its results kindly, falling on the day the results came out. Now, the problem was its margins. The company's gross margin dropped from 12% a year earlier to 9.7%, a 230 basis point compression within a year. In fact, as recently as the December quarter, the company had made a profit of Rs 171 crore, nearly twice what it did last quarter, despite lower revenues. The miss was serious enough, in fact, that P&G filed a separate clarification with the stock exchanges the day after it released its results, specifically detailing why its margins collapsed so much. Now, the cleanest quarter of the three belonged to Kalyan. Its consolidated revenue was up nearly Rs 10,300 crore, up 66% over the same quarter last year, and its net profit at Rs 410 crore more than doubled from last year. But what sets it apart, though, was that its margins, unlike its two peers, were stable. In fact, its EBITDA margins grew from 6.5% to 7.2%. Individual stores of the company, on average, grew phenomenally well, with same-store sales going up 47% over the last year. Now, most of this growth came from outside South India, and its non-South stores now make up 3/5 of its business, a major shift for a company that built itself in Kerala. So this quarter was, in short, one of divergence. There was something structurally different about these three businesses which pushed their numbers in very different directions. Dig deeper there and a more interesting picture emerges. So jewelry retail isn't really one business, it's three. A jeweler usually makes no profit on the gold they sell, and the gold they use flows through them roughly at cost. What they buy at market rate, they sell at market rate. Their money comes from how they change the gold in between. Now, a jeweler can simply sell bars and coins, but the economics are brutal. A customer pays close to the spot price, leaving the retailer a spread of 0.5% to maybe 1%. That's all they get, and there's no craftsmanship to charge for, no design, and therefore no making charges. They're essentially a bullion intermediary. Now, one layer above, a jeweler can sell plain gold jewelry, unadorned chains, plain bangles, simple necklaces, and the like. This adds extra making charges of roughly 6 to 15% of gold value, and they also get to pocket a brand premium plus a wastage allowance. In all, the gross margin here lands in the 12 to 13% range. Finally, there's studded jewelry, pieces with diamonds or other stones. The diamond carries its own markup, the gold component still earns its making charges, and the design premium is highest of all. Gross margins on a heavily studded mix can run as high as the mid 30s. So the three, in other words, are functionally different businesses with very different dynamics. If you know which of these a jeweler sells in what quantity, their margins become much easier to understand. So last quarter, PN Gadgil's bullion sales, for instance, went up from 28% of revenue to 40%. In each rupee of revenue in that added share, its margins dropped from approximately 12% to practically nothing. Even Titan saw a similar compression with their lower margins flowing almost mechanically from that shift. But why did the mix shift so drastically? So when gold prices rise sharply, customers react very differently. As Kalyan's management noted, they don't expand their budgets when the gold gets expensive. Instead, they shift downwards. They try to maintain the amount of gold they're actually acquiring while cutting down what they pay for design. So a customer who came to buy a chain, for instance, might leave with a coin instead. Now, in a quarter where gold prices went up 60%, this was visible across the board. The question before each company then was whether they would lean into the trend or not. Titan and PNG chased the trend, letting their bullion sales rise massively. Kalyan, as its management clarified, did not. In fact, Kalyan held on to its high-margin studded jewelry business for dear life. Its studded share stayed essentially flat at 31.2%, while Titan slipped from 34% to 31%. While we don't have year-on-year figures for PN Gadgil, sequentially, its studded ratio fell from 8.2% in the December quarter to 7.3% last quarter. That made all the difference. So that's the demand side of the story. But there's a second thing going on at the same time. The way Indian jewelry is sourced is being rewired. So a jeweler can get gold three ways. They can import it via banks, paying customs duty, GST, and dealing with FX rates. They can borrow it via a gold metal loan where a bank lends physical gold for 6 to 9 months at a much lower interest rate than a rupee loan. Or they can buy it from customers through an old gold exchange program. Now, the last of these, the exchange channel, is always the cheapest. But each of these treats gold exchange differently. Titan's is usually the most aggressive. This quarter, their exchange program was so successful that customers ended up bringing in more old gold than the company actually needed for manufacturing, and the surplus was turned into bullion. This was partly why their bullion sales jumped sevenfold. They bought way too much gold and didn't want to keep it all in their inventory. PN Gadgil, interestingly, is doubling down further on its old gold exchange program, making it the centerpiece of next year's strategy. Old gold is already 40% of PNG's business, and its management wants to raise that figure to over 50% through a program they called Suvarna Bharat. The company revealed this strategy after the recent import duty hike, claiming that the duty hike would help its margins as customers would shift to buying new jewelry through old gold exchange. Now let's think of this from the customer's perspective. So someone looking to get married this year probably walks into a jewelry showroom this year with the same budget she would have had last year. Only gold has gone up 60% since. Her money can buy much less metal. Exchange is one of the best solutions she has. She can bring in inherited or older pieces which are valued at close to spot price and only pay making charges on the new piece. It's a win-win. The retailer gets cheap gold while the customer gets to maintain the purchase she planned. Now, at a more macro level, exchange opens up interesting economic possibilities. With gold imports weighing down our import bills, Indian households sit on something like 25,000 to 30,000 tons of gold. A good exchange program opens up a truly enormous supply pool. So, how much growth was borrowed? Now, there's a final mystery in these numbers. If gold prices have been skyrocketing, why did sales grow so substantially this quarter? Titan, for instance, reported buyer growth of 8% in Q4 after 9 straight months of flat numbers. To the company's management, though, it's too early to celebrate. And this might come from one-time phenomena. For instance, buyers that were sitting on the sidelines waiting for prices to stabilize might finally be capitulating. Two, many people may have made wedding purchases early, afraid that costs would go up even further. Kalyan offers an even more interesting story for its massive same-store sales growth. So we are currently in Adik Mas, a particularly inauspicious month that traditionally mutes wedding demand, and this may have pushed many to advance their purchases. Similarly, the management of PN Gadgil attributes its incredible 86% same-store sales growth to a one-time stack of promotional events. Their reasons may be different, but the upshot of all of this is the same. It's hard to tell if these Q4 numbers were actually structural or if all that business was borrowed from the current quarter. But that we'll only know with the next set of results. Now, this was the story of last quarter, and it's unclear if the trends we saw are structural or if things will soon change. But the future, if anything, is even more uncertain, and the ground has recently moved under the industry's feet. On 13th May, the government raised the customs duty on gold from 6% to 15%, and even silver imports saw a similar change. This is one of the largest single duty hikes the sector has seen in years, and all three stocks instantly dropped in reaction to the news. But the move doesn't touch them all in the same way. Titan seems best placed to handle the transition, and as its management noted, its exchange program is the largest in the country. It also has other advantages, including its sheer size, which gives it flexibility that its peers do not have. Kalyan too enjoys some structural insulation. It procures heavily through gold metal loan while hedging most of its price exposure, and most of its stores are owned by franchisees, who may be forced to absorb part of the working capital pressure. PNG is the most exposed in the short run. But as we noted above, though, for now, its management bets that the duty hike will help its margins by pushing customers away from buying bullion. All of this, however, is plain conjecture. And there's a lot to look out for in the next quarter's results. We go through tons of investor presentations and reports while researching our stories. So we thought, why not compile the best infographics, charts, tables, and slides into one newsletter? That's exactly what we do in Points and Figures, a weekly newsletter we send out every Tuesday. Link is in the description. Coming to the second story. Indian municipal bonds are having a moment. In February, the Union Cabinet approved the Urban Challenge Fund of Rs 1 lakh crore with a rule that at least half of every project's cost has to come from the market, including bank loans, PPPs, or municipal bonds. So the central government, under the Amrut 2.0 urban mission, is literally paying cities to issue bonds. A first-time municipal bond issuer gets a grant of up to Rs 13 crore for every Rs 100 crore raised. The BMC has finally said it's preparing its first ever bond after 133 years of being asked. Now, this made FY26 the busiest year for municipal bond issuance ever. 9 issuances by December 2025 against 3 in FY25 and 1 the year before. We covered this in our primer on India's municipal bond market a few months ago. And at this moment, SEBI dropped a consultation paper suggesting a bunch of changes in the municipal bond regulations it first wrote in 2015. But to understand what this paper is trying to do, it helps to know where the Indian bond market actually stands, because it has many parts. First, there's the government bond market, GSEX, which is deep and well-functioning with Rs 150 plus lakh crore outstanding, trading every day, used by every bank and insurance company in the country. The corporate bond market, on the other hand, is growing fast, but is less mature with about Rs 50 lakh crore outstanding in FY25. And then there's the municipal bond market of just approximately Rs 4,500 crore cumulatively. That's the amount raised from 22 cities across 31 issuances over 11 years. That's less than 0.1% of the outstanding corporate bond market. Now, what SEBI is doing with this paper is trying to make the municipal bond market look like the corporate bond market. The corporate bond market itself isn't deep, and the municipal market is being asked to play catch up to a market that hasn't fully figured itself out. So there's another way to think about it. The municipal market is so small that nothing SEBI does to it really matters. Even a doubling of activity would be a rounding error in India's broader bond universe. But then the market is so small that any structural change might compound dramatically. And the unlock, if it comes, will look outsized. Now, we don't really know which reading is right yet. But what we'll narrate to you is the reforms in the paper divided into supply side and demand side changes. First, we'll start with supply. The reason there are so few municipal bonds is that there are so few municipal bodies that can issue them. Of the roughly 4,000 urban local bodies in India, only a few dozen run audited, accrual based accounting, have healthy credit ratings, and have the structured payment mechanisms that bond investors require. Most municipal bodies are tiny, financially opaque, and politically constrained. Obviously, it's beyond SEBI's mandate to fix that. But what it can do is widen the doors for the cities that are ready. And the biggest move in this direction is their new framework for pooled financing. Now, the idea itself isn't new. Several small cities come together and set up a special purpose vehicle or SPV. So instead of the cities themselves, this SPV issues a single bond on their behalf. Money raised flows down from the SPV to the participating cities. Repayments flow back up as each city pays into the SPV and the SPV pays the bondholders. So this design solves the size problem. A small city like Agra, for instance, can't justify the fixed costs of an issuance on its own. And this includes merchant banker fees, rating agency fees, legal fees, etc. Its balance sheet is also not strong enough to attract investors. But 10 cities like Agra combined can clear both bars. And the risk gets spread across multiple issuers, which makes the bond easier to rate and sell. The Government of India formalized this concept in 2006 through the Pooled Finance Development Fund scheme, but nothing translated into actual meaningful issuances. So what SEBI is adding now is the operational playbook that was missing earlier. It's introduced a new disclosure framework for SPVs created to pool borrowings across cities. Now, before raising money, every city in the pool has to sign and disclose a formal agreement with the SPV, which can be set up either as a trust or a company. The structure also comes with a layered escrow system. Each city will maintain its own interest payment and sinking fund accounts, and that money will then flow into matching accounts at the SPV level. And on top of that, the SPV must always keep reserves equal to 1 full year of interest payments. The framework also clearly lays out the kinds of credit support these pooled structures can use, including cash collateral, equity support from state governments, access to state finance commission devolutions, and partial or full guarantees from development finance institutions like the World Bank. Importantly, the rating agency assessing the bond cannot just rate the SPV in isolation. It also has to evaluate every individual city in the pool, making it harder for weaker municipalities to hide behind a stronger pooled structure. The paper also formally enables ESG debt securities for municipalities. Green municipal bonds already worked under a 2022 circular, but this brings social and sustainability linked bonds in line. The fit is obvious. City projects are mostly related to water, transport, waste, and solar. Now, the paper also tightens end-use restrictions. And what this means is that no more than 25% of bond proceeds can go to working capital. The rest has to fund the capex of the project itself, and there's a flat ban on using proceeds for general purposes. This ensures that the bond money is primarily directed towards infrastructure more than anything else. And then there's a small technical line on refinancing. Until now, cities could use bond money to retire existing bank loans without disclosing what those loans looked like. The paper fixes that. Issuers now have to disclose all the details of the loan being refinanced. But supply needs to be matched by adequate demand, and almost nobody in India can buy a municipal bond. Now, this requires understanding a distinction that's central to how the municipal market, much like any bond market, currently works. It's the split between private placements and public issues. See, a private placement is sold directly in large lots to a handful of institutional investors like insurance companies, pension funds, mutual funds. A public issue is sold to anyone, including retail investors, often in small denominations. So, of the 31 municipal bond issuances since 2015, 28 have been private placements. Now, private placements can get listed on a stock exchange after issuance, and once listed, anyone can theoretically buy them in the secondary market. But the trading lot is set at the face value of the bond. Since SEBI's existing rules don't specify any minimum face value for municipal private placements, issuers default to rupees 1 lakh per unit. And a retail investor wanting to buy a single listed municipal bond in the secondary market needs rupees 1 lakh minimum just to participate. That's too steep a barrier. So the first big demand side move in the paper fixes exactly this. The minimum face value for privately placed municipal bonds gets formally set at either rupees 1 lakh or rupees 10,000, with the rupees 10,000 option available only for plain vanilla bonds. SEBI made a similar adjustment for corporate bonds in July 2024, which brought a wave of retail investors into corporate debt for the first time. So the plain vanilla restriction is a consumer protection measure because complex structured bonds can get missold to retail, so SEBI is keeping retail capital exposed only to simple, predictable cash flows. So a 10,000 rupee trading lot on a listed bond with a healthy credit rating yielding 8% is genuinely accessible to retail, and it plugs municipal bonds into the same digital distribution infrastructure that corporate bonds now use. Now, the more crucial retail unlock comes not from making private placements more retail friendly, but from getting cities to do more public issues. After all, public issues are designed for retail from day one. They advertise broadly, allocate quotas to retail and high net worth individual or HNI categories, and use small face values by default. For instance, in October 2025, Surat had a public bond issue at a face value of rupees 1,000, allocated 15% of the issue to retail, and got oversubscribed by 8 times. Indore did the same thing in 2023. The retail category alone was oversubscribed nearly 6 times over. It seems Indian retail investors are indeed receptive to municipal bonds. But the question is whether more cities will choose this route. This is where the paper's other demand side moves come in. There's a new provision letting issuers offer incentives to senior citizens, women, retail individuals, and defense personnel. And this could take the form of a slightly higher coupon or a discount on the issue price. It's a small sweetener that's limited to initial allottees, but it gives public issues a way to compete with bank fixed deposits and post office schemes for retail savings. Now, SEBI's job here is to fix the regulatory plumbing, but it can't do much more than that. On the supply side, the binding constraint is municipal readiness. Most of the 4,000 municipal bodies in India don't have audited accrual based books. Most rely on grants from higher tiers of government for the bulk of their revenue. Most have property tax collection efficiencies that wouldn't survive a credit rating. And most have no track record of issuing in capital markets and no internal capacity to prepare one. SEBI can't make a city collect more property tax or affect the fiscal positions of cities. Until that happens, the supply of bondable cities stays narrow. On the demand side, even with retail access, the secondary market doesn't really exist. Most institutional buyers hold to maturity. There are no dedicated market makers and pricing is opaque. A retail investor who can now buy a municipal bond at rupees 10,000 still can't easily sell it before maturity, which makes the product less attractive than the headline yield might suggest. Liquidity follows scale and breadth, both of which depend on more cities issuing more bonds more frequently, which loops back to the supply problem. Whether you read that as a meaningful step or as housekeeping for a market still too small to count probably depends on how much of the rest of the urban finance push is going to land. Either way, it's a small, coherent push in the right direction on a market that has, until very recently, refused to move at all. Now coming to the tidbits. Dr. Reddy's has rolled out its generic semaglutide injection in Canada, becoming the first Indian company to commercialize a low-cost version of the blockbuster diabetes and weight loss drug in a G7 country. The launch comes after Health Canada cleared the once-weekly injection in April after having earlier blocked it. Coming to the second tidbit. The DGFT has shifted silver bars of 99.9% purity and certain other categories from the free to the restricted import list, meaning importers now need a government permit to bring them in. The move follows a steep hike in customs duty on gold and silver from 6% to 15% effective May 13th and is aimed at curbing the import bill and easing pressure on the rupee amid West Asia-driven volatility. Coming to the final tidbit. Dutch lithography giant ASML has signed an MOU worth $11 billion with Tata Electronics to supply tools and expertise for India's first commercial 300mm semiconductor fab in Dholera, Gujarat. The deal was inked during PM Modi's visit to the Netherlands. That's all the news I have for you. Thank you so much for watching and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.